Hello and welcome to Vox Markets. I am John Hewman and I'm joined again for our monthly chat or monthly-ish chat by John Rosier. How are you doing, John?
Very well, thanks. Yeah.
Excellent.
Been away for a bit, so full of energy.
Nice. It's been an interesting month. I think we've had some pretty horrible months in the last year since we began talking, but June started to get better and seems to be continuing. And I guess that's something you're benefiting from in your portfolio.
It certainly got better for me. First 5 months were pretty horrendous. I was down, and not only down, but sort of much worse than FTSE All-Share, which ultimately I want to beat. But June was better, so up nicely, beat the index, and July so far is going well again. I mean, basically all those commodity holdings I had, which hurt me in the first 5 months, they're doing a bit better. It's like they're bottoming out. Maybe people are looking towards interest rate cuts, and there's good value there. But also the other stocks that I hold outside commodities have generally had very good sort of results and updates, and are performing well.
Yeah, we'll go through those. I mean, commodity strikes me as a long-term play anyway. I think reading through your site, the main thing is the energy transition and the metals required for that. So definitely understand why you stick with those.
Yeah.
But in terms of what's done well this month, there's a very interesting business. We discussed it briefly before, but Niox, however you pronounce it. This one fascinates me. And I had a little chat recently with a chap called Christopher Mills, who runs the North Atlantic Smaller Companies Investment Trust, and this is a favourite of his, and it's done really well for you this month. Let's have a chat about Niox.
I mean, they own about 30%.
Big.
I mean, they're not far off that. And yeah, I think they put the new CEO in a few years ago to sort of sort out the business, and that's exactly what he seems to be doing. Well, the first bit was sort of sorting things out, getting costs, focusing on the one main machine, the Niox machine. But then, having sort of done that, they're now really seeing the sales growth come through. So they updated at the 4-month stage, and I think it was growing at about 28.7%, something like that. At the 6-month stage, they updated earlier this week. It's growing at 29%, and margins are good, and so big upgrades to earnings coming through for the full year.
Yeah, it's a double whammy. It's a double whammy, isn't it, of cost reduction and now top line growth. I mean, the cost base, I think Christopher said it was reduced from 32 to 14 million. I mean, that's a huge amount of cost taken out of this.
It is, and I think that a lot of the growth that comes, it doesn't really need much increase in the cost base at all. Maybe a bit of sales and things like that. So good sales growth, lots of cash, generating lots of cash, and it's paying a maiden dividend. 2.5p, which when is it? XD 17th of August. So that that's not a bad dividend on the current share price. Getting sort of 4% yield.
It feels like the end game for this one is a takeover of some description, a sale at some point.
That would be nice, but not too soon.
Not too soon. No, absolutely.
I'm sure they won't give it away.
No, absolutely. What else has done well this month for you? Hargreaves Lansdown, they had an update quite recently, and this is a recent purchase of yours. This is I looked at this and I'm looking at it thinking there's real value here. This is a market leader that you can get for less than 13 times earnings. It's
Yeah. Well, I bought it beginning of last month, and I mean it was mainly the valuation that it appeared on my main sort of screen. There's only about 10, 11, 12 stocks on that, and it appeared there. So I had another look at it, and it was the valuation that appealed to me. But also, if you looked at the earnings per share, everyone's got a bit of a downer on Hargreaves Lansdown. But if you looked at the earnings, they'd actually been upgraded significantly over the last sort of 9 months or so. And so I thought, well, earnings upgrades and a cheap valuation, it was only down about 13 times earnings. It used to be this huge premium. And also, again, good cash flow. And a great yield, and the yield now actually having run up to about 4.5%, but it was yielding over 5%, so that attracted me towards that.
Yeah, I guess the worry with Hargreaves was that you started to see some really aggressive competitors, really having a pop at its market share. So AJ Bell and Interactive Investor in particular, but it's hanging on to customers. This is quite interesting.
Yes, it is. Well, yes. I mean, net new customers, I think, were up 13,000 over the quarter. It's like people moving bank accounts. A lot of people just can I be bothered? It's a reasonable amount of work to go through. And also the other thing about Hargreaves is people look at the costs and things, and I think you can get cheaper. But generally, their administration, I think, has been pretty good.
Yeah.
But, I use them, and I say I've never been disappointed on the sort of admin front with them. But in the background, you've got the founders, particularly Peter Hargreaves. He's still got a big holding, sort of causing a little bit of trouble there because he sort of thinks they let their cost base get too high. And so, there are sort of changes at the top. And so maybe that'll be pared back a bit, the sort of approach they've had and bring costs down a bit. So anyway, but I mean, as things are, they're growing pretty well at the moment.
Yeah, we'll bring those costs down as well, and even better news for shareholders. The earnings will benefit obviously proportionally to whatever costs they take out. So no bad thing. You've got a bit of an activist founder there sitting behind the scenes.
Yeah, no, I agree with that. And then the other one, so Howden was up 12%. This is basically over the last calendar month. And they had an update the other day. I mean, their busy period really is in the second half. In the autumn, but so far it's in line with expectations.
Yeah, this one I found interesting because there have been obviously some serious concerns about the health of the consumer in the face of the cost of living crisis. So I guess one of the things that would have helped Howden out this month is we've had some much better news on the inflation front.
Well, yes, it did, because it started running on those inflation numbers, so it ran before their update. And I guess, yes, people, if people suddenly feel that maybe mortgage rates are peaking out here and that there's better news on the horizon, then Howden looks cheap compared to history. So you can see why people would have gone towards cyclicals like Howden. Now, might the market get ahead of itself?
Almost certainly.
Probably, because I should think, by the autumn. I mean, it's a class act album, but I mean, if there really is a slowdown I guess the main thing is housing turnover. If people aren't moving house, then maybe that's when you do get a new kitchen and things when you move in. Although, the argument might be the other way, that if you're not moving house, why not just buy a new kitchen? I don't know.
Improve, don't move.
No, it's one that I'm sort of watching. In truth, would I go out and buy it today? I'm not sure I would, personally. I mean, I've got it in the portfolio. I'm happy. It's not a huge holding, but I wouldn't chase it, I don't think.
Yeah, it is a great business, and I have, as a customer, I've used them. It's a really very, very easy experience, and I think the trade model has always set them apart. The fact that they essentially use the trade as their distributors.
Yeah, and I think I read something like, the aim is to have one within sort of 5 or 10 miles of every sort of house.
Yeah,
and I think they can get 1,000 in the UK. They think distribution centres. So there's still that sort of growth, and they're now growing in France, well, overseas, mainly France, and it's growing quite quickly in new depots. But and it seems to be working there, but it's still very small in the context of things.
Yeah, it's a nice business. It's a nice business.
So those were the three sort of best. I had the poor one. It was STI Group, so that's down 17% over the last month, and I just think the valuation got ahead of itself, and they benefited from some one-offs in one of their divisions called Attic Cameras, sort of COVID-driven orders, and they disappeared, and that's hitting them for a good, I think it's about 8-9 million. So they've got to make that up, and so this year is going to be more difficult for them. So
what do they do exactly?
Well, FDI Group is, if people have heard of Judges Scientific,
Yes,
it's a
yeah.
similar model, but it's much smaller. It's probably a quarter of the size, and so they make acquisitions in the sort of scientific instruments space. They're pretty disciplined about what they pay. From memory, around 6 times sort of is what they're looking to pay. So they're disciplined on that front, and they get decent earnings upgrades with each acquisition, and generally their record has been pretty good since they started. So I look at the forecast now, and actually on a rating, it's looking much more attractive. And I think earnings will be upgraded. I mean, the year to May, it's a May year end. And so if looking to May 24, I'd expect, there'll be maybe 1 or 2 acquisitions before then, which should be enhancing. And as long as the UK economy doesn't completely sort of tank, then I'd expect those earnings to be higher and help the rate again.
Yeah,
so that's
nice little subsector, the scientific instrument sector. But as you rightly point out, it does have a tendency to get a little bit hot on the valuation front every now and then.
I mean, Judges, I mean, only one look at the chart there, it's been fantastic, but it's not been a straight line.
No.
Bottom left to top right. Then the other one, it didn't. I mean, Serica was down 11.5%, but that did include an ex-dividend of 7%. So that's not so bad. But then lots of others. I mean, Shoe Zone, amazing upgrades from them.
It's incredible the pace of upgrades there and frequency. I like an upgrade cycle, but this one's something else.
I mean, it slightly worries you, doesn't it? It slightly worries you because if you can get an upgrade of 20-odd% in June, and then literally a month later another upgrade of 28%, it sort of feels like, well, I don't know how much visibility is there. I don't know, but anyway, they're benefiting hugely from, I guess, people trading down, plus a lot of self-help. I mean, they've been improving their sort of portfolio, their estate of shops. And then the other thing they mentioned was the big drop in container prices. So, a lot of these shoes will come in from the Far East and things. And that's been huge. I mean, because obviously container prices skyrocketed sort of post-COVID with the rush to open up and everything, but have come now right off.
Yeah. I do wonder. I mean, we are seeing these sort of, obviously inflation is moderating, but we do still have inflation. But when you start to see, things like container prices dropping so rapidly, and metals prices or dropping, commodity prices dropping so rapidly, it does make you wonder about the strength of the economy ahead. And I mean, is it something that you consider? I know you're not a macro investor.
I don't know. Well, you see, China's obviously been disappointing in terms of the economy rebounding as they opened up. It really hasn't done much, and I think I saw inflation there's sort of 0% year on year. So are we back to the old thing of China exporting deflation again? I mean, for the second half of this year, inflation figures could look pretty good. In the US, another month or two, and they'll probably be at their target. I wouldn't surprise me. I mean, they're only 1% away now. And then in the UK, you've got July, you've got the energy, the fall in energy prices coming through. So these figures are going to look better. Now that doesn't tell us what's going to happen next year, because this year you've got the big benefit of the sort of base effect. Because you had high inflation and you're just getting this. But then next year, if inflation starts to tick up a bit and things, and maybe the market will get worried. But no, I feel reasonably positive about it.
Yeah, there was a bit of a wobble. The Nasdaq had a bit of a wobble yesterday. I mean, I think there are concerns that the AI bubble is in full swing, and that this is all going to be a bit overheated. But I think there's also concerns, looking at sort of jobs data over in the US, that actually the strength of the labour market means there might actually be further to go in the hiking cycle.
Well, yes. I mean, I think another 0.25% there is nailed on, partly because they've said they're going to do it, or indicated they're going to do it, and if they didn't, it wouldn't look very good. So and I think they're looking at those figures. But in the UK as well. I mean, I think we'll definitely see another 0.25%, but because again, they probably feel they have to.
Yeah.
But yeah, I mean, I just think second half that things could do better. But back to the US, you're talking about NASDAQ. I mean, in my funds portfolio, the area I'm sort of looking at, I haven't done it, I haven't pulled the trigger yet, but what I'm looking at is sort of, if I'm feeling a bit more bullish about the US market as a whole this year, but I think you're going to see the broadening out because it's all been led by the the largest 5-6 stocks basically, and outside those there's been very little movement. So maybe the Russell 2000 or an investment trust that sort of invests in US small companies could do well, I think.
Yeah, worth a look. Well, before we wrap up, there's one other thing I wanted to have a look at because you hold Polar Capital.
Yes,
and I know you put an update out this month on their asset under management figures. Now, this is a funny little sector. We saw a bid recently for Gresham House, which is not the same but similar. And this has been a sector that's not been very loved. The sort of specialist asset management sector. Perhaps looking through the lens of Polar, what are your thoughts on this little sector?
Okay. Well, what I like, on the sector as a whole. I mean, obviously, it's got a nice big beta against it. If the market goes down, generally people will worry about earnings, and because they earn their fees as of assets under management. So, they have been hit, possibly too far, and you're seeing a situation where there's bids or either bids, or you've had sort of mergers, so sort of Rathbones, Investec, Wealth and things. So for reducing costs and going forward. Now, from Polar's point of view, I think, I mean, it could be bid for, but I'm not quite sure. I think it would have to be a very good bid for the major shareholders and man to be interested in it. So, I haven't bought it because I think it'll be bid for. I bought it because I think it's well managed. I think they've got a good suite of funds. The Global Healthcare Fund, the Technology Fund. I say it's well managed in terms of the cost management. The fund managers will take a share of performance fees and things, but in tough times then they won't get as much. And basically it went XD the other day, 32p, that was its final dividend, but that's 46p for the year, same as it paid the year before. But that's a 9.5% dividend yield.
That's cheap.
And well, unless the market tanks, if the UK stock market's down 30%, or the US is, and the UK and everything in a year's time, then maybe they'd cut the dividend. Yeah. But they've got a lot of cash, very strong cash flow, and they've shown in the past during sort of market fallbacks and when the profits have sort of drifted back a bit, that they've stuck with their dividend. So, I mean, I'm happy to collect the 9.5% while I'm waiting.
Yeah. It's similar across the sector. I'm looking at impact asset management, which is obviously slightly different sector, but in terms of what it invests in, but nevertheless, a specialist asset manager, and that's you've got a 4.5% forecast yield on that. So I do wonder whether there's value in this. As you say, I think it might have got oversold.
I mean, the thing is, it's the same price as when I bought it in July, 15th of July last year. Is when I bought the holding, and it's pretty much exactly the same price, but I've made a 15% return.
There you go. Dividends matter. Dividends matter.
Yeah,
absolutely. Excellent. Well, that's brilliant, John. Always a pleasure talking to you. Really, really interesting insights into what's been a great month. Let's hope it continues for the rest of the year.
Good. Fingers crossed. All
Absolutely.
right. Talk to you next month.
Thanks, John.
Bye.